Pleasure.
What's your latest thoughts on where the U.S. economy is headed?
Well, I mean, I think the U.S. economy, the fundamentals are still pretty good. Some of your other guests have said the rest of the world's not doing so well. I think the trade war is hitting China very hard. It's hurting a lot of China's trading partners. And China was probably on a slowing curve before that happened. I think they're looking at slower growth over the next 10 years by a lot than they had the previous 10 years. The U.S. economy, the fundamentals are good, but there's a lot of policy uncertainty, and I think that's undermining business confidence. It's slowing investment. I think that's the biggest drag on the U.S. economy by far.
Do you think we're in a period where we can expect a recession, given the yield curve inversions and some of the weakness you're talking about overseas?
You know, it clearly, after not having a recession for so long, and given that in a typical period, you probably have a 15, 17% chance of having a recession in a year. Yeah, the chances are probably somewhat elevated, but I think they're clearly below 50-50 even over the next 2 years. And a really steep recession would take a lot of, bad moves going into it. It could happen in this environment, that's for sure. But no, I think the yield curve inversion I would not read too much into. And the thing is that long-term rates have been trending down. And I think the market's been adjusting to it. I think the Fed policy's been adjusting to it. Absolutely, there was a panic last week. People are still very nervous. But it nevertheless is not the indicator that it traditionally was.
Professor, let's imagine I'm in your classroom and you're teaching about negative interest rates. Tell me, as somebody who wants to understand this, why they persist and why it is that investors are willing to obviously give their money to, for example, the Bundesbank for 10 years or the government of Germany and get less back at the end.
Well, we've had negative real interest rates for a long time. We are in a very low inflation period. And you can be asking the same question when inflation is 4%, why were people willing to take 3%? I think it's a lot of similar dynamic that people will take a lower yield on a bond out of safety. And particularly during periods of acute uncertainty, that premium that stocks have to pay over bonds can be higher. And I think we're going to see negative interest rates from time to time everywhere, including the United States, over the next 10 to 15 years, if these low long-term real rates persist. I don't think this is QE. This seems to be something that's worldwide. And when there's a recession, to the extent central banks have tools, they may reach to try to do negative rates. Now, the U.S. needs to make a lot of adjustments. Frankly, Europe and Japan do in order to really make them effective. That hasn't happened yet. So I don't see steep negative rates.
Right. But just the whole idea of it seems counterintuitive. I mean, is it a reflection of people's fear of deflation?
Well, it's a reflection of very low inflation. So when inflation not so long ago, it was 3% and 4%. And people would take 2% and 3% paying on bonds at times, certainly during recessions. That is a negative real return. It is the same thing. It's the same dynamics. We have very low real rates, and it's pushing the rate negative to clear the market.
And you think that could come here to the United States as well?
I think eventually it will come here to the United States. It may happen sooner rather than later. However, the United States, beyond the Federal Reserve, the government would have to take a lot of steps in changing tax laws, regulatory laws, and particularly how to deal with cash hoarding to really have negative rates dip very far. That's a longer story. I think it's actually the future, but it hasn't happened yet. So I don't expect anything dramatic. But we could see longer-term rates dip down because people will see the handwriting on the wall.